A lot of people have the misconception that if sales are up, then their business is doing well. But did you know that it's common for businesses to go broke even when sales are rising? After 20 years as an accountant, I have seen 3 surprisingly common habits that quietly drain businesses during the good times. And by the end of this video, you'll know exactly what they are and how to avoid them before they cost you everything. Before we get into it, let me know in the comments if you've ever had a moment where you thought you were doing well, only to check the bank account and wonder where all the money went. And speaking of keeping more money in your business, for today's video, I've partnered with Xero, one of the world's most popular cloud-based accounting programs which helps small to medium-sized businesses manage their finances online, and I'm happy to tell you that I've secured a special offer of 90% off Xero for 6 months when you use the link below. This offer is valid at the time of recording, so make sure you click on the link in the description below and grab the offer while it's still available. Okay, let's dive into the 3 main habits that cause businesses to go broke even when sales are up. Bad habit number 1, the spending trap. When sales go up, many business owners start spending to match their success. Now, yes, you do need to spend to grow, but it's easy to slip into a spending trap where you're not spending on real growth, but spending to look good. That's what I call ego spending. For example, some business owners may splash out on a fancy car, a flashy, bigger office, or more staff than they actually need. It feels like growth, but it's actually really not. As one business owner admitted on LinkedIn, I was more focused on looking successful than staying solvent. Bad habit number 2, not knowing your numbers. This one is incredibly common. I've had the experience so many times where a business owner tells me that they're not good with the numbers, so they just avoid looking at their financial reports and discussing the numbers altogether. And I'm talking about smart people who could easily understand their financial reports if they just took the time to learn about them with the help of their finance staff. You see, when you don't review your financials regularly, you miss the early warning signs that your business might be running into trouble. Things like rising costs, shrinking margins, or late payments. For example, I once dealt with an e-commerce seller who assumed more sales meant more profit. When we dug into the numbers, every sale was bringing in $60 in revenue, but costing $58 to fulfill and ship, and that didn't include her ad spend. She thought she was making money because the orders kept rolling in, but she was actually losing a few dollars on each sale. Once she took the time to learn about the poor state of her finances, despite the high sales numbers, she was able to put together a plan to save the business from running out of cash. Which brings me to bad habit number 3, cash flow blindness. Even when your business is profitable on paper, poor cash flow can still bring you undone. One of the most overlooked elements of cash flow is the timing of money moving in and out of your business. This mostly comes down to how quickly you get paid versus how quickly you have to pay others. You can make a profit overall, but if your cash is tied up in unpaid customer invoices or excess stock, you can still run short. I once worked with a consultant who found this out the hard way. On paper, his business looked healthy, plenty of clients, and solid revenue, but half his invoices were being paid 30 to 60 days late. Meanwhile, he had wages, rent, and bills that had to be paid every week. So even though he was profitable, he was low on cash and was constantly dipping into his overdrafts just to make payroll. The issue wasn't profit, it was timing. If he took the time to understand this, he could have set up a system to make sure his customers paid their invoices on time instead of 30 to 60 days late. And that's what catches so many businesses out. They don't go broke because they're unprofitable, they go broke because the money doesn't come in fast enough to cover what's going out. So there you go, 3 reasons why businesses are often broke even though sales are looking good. If you've got a story to share about a business that got into financial trouble despite making lots of sales, let us know in the comments. And don't forget to check out the special deal I got for you by signing up to Xero through the link in the description below. Thanks for watching, and I'll see you in the next video.